Hey everyone, welcome back to Upside Down Data. So Bitcoin is rallying so far this week, and as a result, in this video I'm going to take a look at our risk and trend indicators. That's the upside downside potential indicator for risk and the trend confidence indicator to see what we should think about the trend and whether it might be changing, both for Bitcoin. And that's going to give us an idea of whether this move over the last couple of days is a big deal or not. So if you guys like the content, throw us a like and a subscribe, and let's get into it. So this is the daily price chart for Bitcoin just to get our bearings here. On the day so far, price is up almost 5%, and over the last 2 days, so far this week, it's up between 7 and 8%. So, nothing huge, but still a move that follows a few days of consolidation and a few days of red. So, people are feeling more hopeful than they were before. This yellow line that you see up here is the 200-day moving average. I have this up because it's an important level when we're looking at the daily chart. It's where the price got rejected off of back in March, and that started the real massive sequence of dumps there that brought us down to this kind of new range that we're in right now. And over the last 2 weeks, the price has been going sideways, and if that continues, eventually the price will meet up with the 200-day moving average, and that will be an important level to see its reaction to, whether it can recover that level, in which case we would start to look for consolidation for a potential move up. On the other hand, if it fails to retake that level when it meets it, that would be bearish sign. So that's an important moving average to watch when we're looking at the daily chart. One thing that people have been saying about this move over the last couple of days is that it looks optimistic because the S&P 500 has not been performing equally well. People are talking about potential decoupling. You hear this every so often because crypto usually is pretty highly correlated with the stock market, and that's especially true during downtrends, and it's been extremely true during the bear market that we've been in over the last almost a year now, or even longer if you want to think about it from that first top back in April of 2021. So in any case, that's the situation. I think the best version of this argument, looks something like this. Here we have a pretty long historical look at the relationship between Bitcoin and the stock market, and the argument here is that when we see a bounce on Bitcoin that's not mirrored in the stock market, um, you know, on all of these um, points on this chart, we're looking at a point following a major capitulation event, after which Bitcoin recovered more quickly, essentially, then a major rally follows. That's the argument, and so people are looking to interpret this most recent move on Bitcoin in the same way. I think that it's a little bit of a stretch, in my opinion. What this person is showing that I think is interesting and worth keeping an eye on is not so much a decoupling. I don't think that's the right word for it. It's a divergence. I mean, if we just treat the price of Bitcoin and the S&P 500 as competing indicators, or the same way we would interpret a divergence between price and a momentum indicator like the RSI, when they go in opposite directions, that can indicate that there's a convergence coming afterwards. I think we could make a similar interpretation here, that these two indicators, these two asset classes are generally highly correlated, and when we see them diverge, that's probably not going to last very long. And so the argument then would be that that's going to resolve to the upside. I just think it's a little bit of a stretch in the sense that we're just getting ahead of ourselves. I mean, the S&P 500 is up today. Um, Here we see the S&P. It was down yesterday, and after one day of that, people were already calling for a decoupling, and that Bitcoin was going to run away from the stock market. I think it's just implausible in the sense that Bitcoin and the stock market are basically at the mercy of the U.S. Federal Reserve right now and interest rates, and it's the macro situation that's really going to decide things. So I think that argument is just a little bit of wishful thinking for the most part. That said, it is useful to think about, and to look at how BTC and the S&P 500 are performing relative to each other. So it is a valid source of information, in my opinion. I think that that's just overinterpreting it a bit. Um, with that said, so what do we make of this move? Well, the first thing that we can look at here is the um, trend confidence indicator, because if we're expecting that this move up represents a change in trend, then that should be reflected on the trend confidence indicator. And in fact, the TCI has a history of calling trend changes before they actually occur. So one really clear example of that is back in 2018 at the very depths of the bear market here, after the final capitulation down into this bottoming range, which ultimately led up into the last couple of years that we've seen here. This was called by the TCI quite early. So you know uh, just a week or two after this bottoming range was established, TCI had already flipped into bullish territory, and it stayed that way until the price had reached, back up close to its prior all-time high. Um, it did eventually flip back down into the red, and so it's a dynamic indicator. But the point is that it has the ability to call these things early, and yet so far we have not seen that change on the TCI chart. Um, the downtrend has been, losing some confidence. So if this continues and the price makes another surge to the upside, then there is the potential for the TCI to become convinced that there is a change in trend that's happened. But that should happen fairly quickly in that reversal. And the fact that the TCI has not called that yet means that we should hold our horses. Another piece of information here that's complementary to this one is the Market Direction Classifier, which tells us where we're headed most likely. It gives you a bias and an expectation about which direction the market is most likely to be continuing toward. And it provides a critical level. When the price is below the MDC's critical level, then the downside is still the most likely direction. And we're still there. The critical level right now for the MDC is about 21,400, and the price is about 20,200. So still a ways to go actually before the critical level on the MDC is in play. So another piece of confluent information here that we have not reversed the important levels yet on this move up so far this week. This is still just hanging out in this potentially bottoming range, or in this range that we're in right now. We can also look at the UDPI. This is our risk indicator for the long term. This is a very kind of macro piece of context here, so you should interpret it that way. This is information that's actionable on a scale of months or longer. And so we've been in this long downtrend on the UDPI with risk creeping lower, um, and it bottomed below -4, which is an extremely low risk profile and historically a very advantageous place to accumulate. Now it's gotten rejected for the time being off of the -2 level and is now back down below -3. So this is clearly an accumulation zone from the perspective of the risk to reward ratio. Um, and I think from the perspective of just about any indicator that you can look for, including on chain metrics, which I'm not going to go into, but there are a lot of important on chain metrics that are flashing, potential bottoming ranges right around now. That could play out over a period of months, just like the UDPI is meant to be interpreted on a period of months. So this is not to say that it would be smart to go all in, but our approach on this channel is to use risk information and trend information to facilitate a dollar cost averaging approach. So we get in gradually when the risk to reward ratio is favorable, and get out gradually when it becomes unfavorable. Clearly, right now, it's very favorable. Question for the UDPI is, where is the next bottom going to be? Is this going to put in a higher low, or are we going to visit eventually, even lower levels of risk? We do see this kind of trend interpretation that you can make on the UDPI chart itself. When there's a reversal happening, um, you will see some kind of rounding action, and you'll see higher lows put in and eventually higher highs put in. Um, but we have not seen that yet. So that's the thing to watch here. We can also look at the short-term UDPI, which is, obviously a much quicker indicator. It oscillates much more rapidly, and it's not really adding a huge amount to the picture. Even on a short-term basis, we see that the UDPI is still relatively favorable, meaning there's plenty of upside potential here, even on the short term. But at the same time, we can also note that during these bearish periods, even the short-term UDPI can stay in these negative ranges for for quite some time. So even though it's a short-term indicator, it can still get kind of held underwater when the conditions are bearish enough around it. And I think that's the situation that we're in right now. So again, I think that this information kind of comes together, and the message is that this is a favorable place to be accumulating, but it's also a place to be cautious, um, and not to expect immediate reversals, or to, I think, indulge in wishful thinking about decoupling from the stock market and all that. Decoupling is just not likely to happen, in my opinion, when the Federal Reserve is in control. So something to keep in mind, and hope you guys found this useful. Thanks for watching.